I knew this week I'm not going to want to trade a lot. I'm not trading any big tech earnings, so I don't need to be looking and fishing for any trades. I don't plan to trade any earnings at all, so I don't care about any of the Dow that has earnings this week. And I know that when there's a ton of manipulation, it can be found during earnings week as well. So most of the time, I'm just going to sit out and not trade. And I know to some people it's probably boring, but it's very effective. I remember back in the day watching my P&L consistently going up. And then every couple of months, ironically and coincidentally, every 3 months, my account would just take a massive downturn. And it was always because of earnings, always because I YOLO'd, always because I wanted to be stupid. Now, as far as news, like we said, we have a lot of earnings coming out. Also saw some layoffs for Disney. We've been covering and talking about layoffs for like a year and a half now. We initially said, as we saw in 2022, that a lot of companies would be focusing on pausing hiring, which we saw. And now a lot of companies are, unfortunately firing and doing a lot of layoffs. I think we're going to continue to see that within this year, not moving the market anything crazy, but something to bring up that another big company is doing a big round of layoffs. So looking at Tesla, really not good. Just going to be straight up honest with you. Tesla's not looking too hot. We're underneath that 170 level, which is really not good. You can see that we're actually holding 160, which is better. We were down at 158.46 today. But ultimately, we're not looking too hot. We have this gap to fill, which we've been talking about, down to about $144. And if we don't bounce up and hold over 170 within the next week or so, we're definitely going to fill that gap back down. And I think if we continue to fill that gap, and if we were to continue to drop from there, our next level would be back down at 110 or $100. So I closed out my hedge, if you guys remember last week, I took a nice profit on it. My long-term shares, I'm not doing anything with. I'm just holding on to those. But the June options I have, they're nerfed. They're down like 89%. I'm just holding those in a YOLO case that somehow it recovers back up to 200, but I completely do not expect that to happen. And then my December calls, what I'm planning to do is close them if we hold this week under 160. And then what I'm going to do is roll them. So rolling an option is just a fancy way of basically saying I'm going to close out the loss and I'm going to open up another position. So the reason that I'm specifically doing this, and there's a lot of reasons to do it, but the reason that I'm specifically doing this is because I want to get a better strike. My strike on those December calls is like 190. I want something way better. I want like a 160, maybe a 155. The other reason, though, is that I want to take better advantage of potential profits in the future via saving on taxes. So when I was opening up a bunch of positions long-term in the past couple of months, I was not planning on really holding them for the next couple of years. I just knew that Shopify was at an insane discount. Meta was at an insane discount. I got picked up GoodRx. I was grabbing some DraftKings and I was grabbing some Tesla too, but my Tesla average is not the best. But when I was, and Amazon calls. When I was grabbing calls and I was grabbing leaps and everything, I wasn't fully playing. I was just like, dude, this is such a ridiculously good deal that I need to be getting into these companies right now because I thought that we were near the bottom. And I was right. I still think the market can make a lower low, but I was right. The issue is you have what's called short-term capital gains and long-term capital gains. So short-term capital gains is taxed at your income bracket. So for me, it'd be like 39%, 40%. That's fucking terrible. But there's ways to circumvent that through long-term capital gains. But for long-term capital gains, you have to hold on to an asset for at least 365 days. Now, when I was buying all those calls, I went 11 months out. And as soon as I opened them, I was like, dude, this sucks. I should have went 18 months out so I can take advantage of long-term capital gains. And then market started running. I didn't want to close my positions. I have a lot of profits, but what I'm thinking about doing, not on this Tesla position, I don't have profits, obviously, but with this Tesla position, what I'm planning on doing is rolling out the position to something that's a year and a half in advance so that when Tesla, hopefully over the next 2 years, pushes back up towards that $300 level, I will get a better tax. I won't have to pay as much taxes on that money, hopefully. Now, the cool thing about that is once we open those up, we can talk about hedging and how to hedge out positions, but there are ways that we can actually reduce risk while still holding on to our position so we can take advantage of the tax laws. But we'll talk about that in a different video. Now, Tesla is currently down 2%, and at this moment, we need to see if we can hold this 160 level or we're going to continue to drop. What would be a good sign that we could potentially start to move our way back up? Well, what we would have to see is a potential bounce and a hold up over 164. On the smaller time frames, there is one or two things that are looking decent here. Number one is that we've been trading within this channel here. You can see for the past couple of months, breaking down, pushing back up, and then trading within this channel once again. The other thing here is that as we're making a lower low, let me actually just turn this off of auto and pull this up. As we're making a lower low over the past couple of days, you can see that our RSI is making a higher low. This is called a bullish divergence. And all this means is that the strength of the downward movement is still there, obviously, but every lower low is a weaker lower low, which means that there is a chance that we could potentially break out and move our way up to 165 or 168. Now, the way that we would want to see this is a push and a hold over this resistance level, which is what we have right here, a consolidation, and then a breakout up to like 165, 167, and then from there, who knows, maybe even back up to 182. Now, I'm not saying that that's going to happen, and I'm not planning on that happening specifically, but what I am looking for is to see if we come up, reject at 166, and start moving our way back down. If that occurs, I'm just going to close out my calls and roll them, potentially even hedge out my position. But at this moment, if you're not in Tesla, I don't personally feel that you have to be taking a trade. I think that shorting at this moment, the RVR is not the best. The best would have been before earnings, of course, but I think going long is not the smartest thing to do right now because we're still trending down on this 1 hour. And I think that we'd have to push and like hold over 168 before I go long, unless it was a super small position.